saturated Wall Street, and especially the private equity realm, where Schwarzman held sway as the CEO of Blackstone Group. As soon became clear, the birthday affair was merely a warm-up for a more extravagant coming-out bash, Blackstone's initial public offering. By design or by luck, the splash of Schwarzman's party magnified the awe and intrigue when Blackstone revealed its plan to go public 5 weeks later, on March 22nd. No other private equity firm of Blackstone's size or stature had attempted such a feat, and Blackstone's move made official what was already plain to the financial world. Private equity, the business of buying companies with an eye to selling them a few years later at a profit, had moved from the outskirts of the economy to its very center. Blackstone's clout was so great and its prospects so promising that the Chinese government soon came knocking, asking to buy 10% of the company. When Blackstone's shares began trading on June 22nd, they soared from $31 to $38 as investors clamored to own a piece of the business. At the closing price, the company was worth a stunning $38 billion, one-third as much as Goldman Sachs, the undisputed leader among Wall Street investment banks. Going public had laid bare the fantastic profits that Schwarzman's company was throwing off. So astounding and sensitive were those figures that Blackstone had been reluctant to reveal them even to its own bankers, and it was not until a few weeks before the stock was offered to investors that Blackstone disclosed what its executives made. Blackstone had produced $2.3 billion of profits in 2006 for the firm's 60 partners, a staggering $38 million apiece. Schwarzman personally had taken home $398 million that year. That was just pay. The initial public offering, or IPO, yielded a second windfall for Schwarzman and his partners. Of the $7.1 billion Blackstone raised selling 23.6% of the company to public investors and the Chinese government, $4.1 billion went to the Blackstone partners themselves. Schwarzman personally collected $684 million, selling a small fraction of his stake. His remaining shares were worth $9.4 billion, ensuring his place among the richest of the rich. Peter Peterson, Blackstone's 80-year-old semi-retired co-founder, garnered $1.9 billion. The IPO took place amid a financial revolution in which Blackstone and a coterie of competitors were wresting control of corporations around the globe. The private equity or leveraged buyout industry was flexing its muscle on a scale not seen since the 1980s. Blackstone, Kohlberg, Kravis, Roberts & Company, Carlyle Group, Apollo Global Management, Texas Pacific Group, and a half-dozen others, backed by tens of billions of dollars from pension funds, university endowments, and other big investors, had been inching their way up the corporate ladder, taking over $10 billion companies, then $20 billion, $30 billion, and $40 billion companies. By 2007, private equity was behind one of every 5 mergers worldwide, and there seemed to be no limit to its ambition. There was even talk that a buyout firm might swallow Home Depot for $100 billion. Private equity now permeated the economy. You couldn't purchase a ticket on Orbitz.com, visit a Madame Tussauds wax museum, or drink an Orangina without lining Blackstone's pockets. If you bought a coffee at Dunkin' Donuts or a teddy bear at Toys R Us, slept on a Simmons mattress, skimmed the waves on a Sea-Doo jet ski, turned on a Growy designer faucet, or purchased razor blades at a Boots pharmacy in London, some other buyout firm was benefiting.